Hey everyone, and welcome to this week's edition of the Swyftx Score. Now, this is going to be an interesting one. I've been talking about this for the last couple of weeks across the squawks, last couple of months even, that we were ushering in a new era with a new Fed chair in the US. Now, what we're talking here, monetary policy. It's hard to make this sexy for you guys, but I think this one is worth your time and effort. I mean, when we think about the whole reason why a lot of us are here investing in different asset classes, diversifying our portfolios outside of just cash and even things like housing, we're looking to try and understand, well, what is the economic landscape for growth and adoption? And for digital assets, the road's been pretty clear, I would say. You may disagree, for the last 2 years, because we've seen regulation, adoption, the entrance of things like the ETFs. So, when we've had all these good news elements come into the markets, it's not really that surprising to now see that a lot of people maybe have lost trust in the space, particularly when certain other sectors, apart from Bitcoin, really failed to make new highs in the last market cycle. Now, my personal take is a lot of this has to do with underlying conditions. What is the state of the pitch, under which we're playing? And that's exactly what the policymakers control. They control the guidance or the rules of, how much is cash worth, which effectively impacts at the end of the day, risk markets like crypto, quite a bit. And so when you see someone come in like Kevin Warsh, who we have just seen, it really is a game changer. Like, we're basically moving into a whole new regime, like I mentioned above, a whole new era. And what I wanted to do this week, it is a longer squawk than usual, but I wanted to distill everything that I learned from this particular meeting. I'm not surprised if maybe you heard a few other people call this one a nothing burger. In my opinion, this is kind of the biggest thing that's ever happened when it comes to, the macro analysis. I think I've mentioned quite a bit, even on the podcast this year and even last year, we moved into very much of a news-orientated and sentiment-orientated market. At least that's the way I saw it. We saw really big divergences and changes in things like an inflation, but it didn't really matter when you had things like conflicts, like the one we're seeing in the Middle East right now, the trade wars, supply line shocks. There were so many exogenous issues away from market trends and the underlying data, it became hard to really understand, well, what does the path ahead look like, right? And, the path ahead, when we talk about it from a policymaker's perspective, is, interest rates is one of the tools, but it really is. Interest rates is one of the tools. Interest rates is one of the tools, but really there's a whole host of other things that maybe have been long forgotten about. And that's what I'm really excited to unpack today. What's materially changing with Kevin Warsh taking his seat as Fed chair, head of the committee that basically sets the rules for economic policy in the US. And the US matters. I think I've spoken about this in the past too. It's the largest consumer base in the world. So if you basically follow the US, you're basically going to understand how the rest of the world might likely move when it comes to the supply and demand of certain things like financial markets. But I think the first place to start is just understanding who Kevin is, what he always wanted to bring to the table, and what he's delivered so far. So one of the key things that he spoke about is that he thought it was a bit of a misdemeanor that previous Fed chairs spent more time articulating and writing Fed statements than they did actually exploring the data. And this is the press release at which came out on the day of the press conference. 3 dot points. I think if you count it, it's like 104 words, 112 words, I think it is. It's pretty minimalistic and very, very Kevin. It's basically, if I had to show you, this is what the previous one looked like under the previous Fed chair. It's a little bit more lengthy, but he's come out basically swinging in the sense that, it's not right, in his opinion, to have so much lean on the market in terms of what you say, rather than people understanding what you'll do based upon data and evidence and what's happening in the underlying economy. And that's kind of brings me to my first point. The big thing that's probably come out of this meeting so far is the idea of forward guidance. It's scrapped. So forward guidance is essentially, we spoke about it before on the squawk over the years. It's something that the policymakers provide the market. It's essentially a guidance framework that, if inflation does this, if jobs does that, this is the pathway that we see interest rates to go on, for example. Now, Kevin's been a large vocal proponent, Kevin's been very vocal even before taking the official position. Some would say It's what earned him the nomination to begin with. That he believed that a lot of this, it is a little bit of malarkey. Like, it is very much, not something that you really want to communicate with the market because it may influence the market. He's of the belief, just hearing him speak, even in his statement, that really it should be the market taking the information that's available, making the best decisions that it can, and the Fed basically looking to understand, or the policymakers looking to understand how that data and what the market's doing, what that relationship looks like. He kind of believes that the point at which the market was looking for the Fed's reaction to how economic data was coming out and what's happening in the world, that's kind of the source of all the problems in which we've seen in recent years. And it was a very interesting take, very polarizing to begin with. But in a nutshell, it really sort of separates him, from people that we've seen in recent past. And, I did a bit of homework myself, this whole idea of being over-communicative and really being super, super transparent to the point where even when there's nothing to say, so much effort was being put into to guiding the market. It's really just been a recent thing. It didn't really start until post-GFC. Ben Bernanke was the previous Fed chair that really brought this practice in, and Jerome Powell, most recent to exit, continued it. He sees this as something that just needs an overhaul, right? And that takes me to my next point, and that is the task forces. So a big point of Kevin's agenda was also to bring in experts to basically reassess 5 major pillars in the way that the Fed operates. This basically looks to overhaul the communications method, which we already talked about already, balance sheets, which very famously we're not going to touch on today, but that's really explaining what we saw in that COVID era, where we saw essentially a whole lot of inflation created and a huge amount of money created that's still driving inflation today. It's quite sticky and quite hard to get rid of. He has historically always been very against this whole idea of balance sheet activity and quantitative easing. So yeah, there's a task force for that one. Data, he's rethinking the way that the Fed thinks about data. The idea that, he sees the private market and the he commented that he sees that the private market is operating and making decisions based on data that's moving much faster and much cleaner compared to some of the more archaic data models that the Fed uses currently. So it only makes sense to overhaul this in the current modern age. Productivity and jobs, that's always been a direct issue that the Fed's responsible for. So essentially a task force looking to study and understand the impact that things like AI will have on jobs and the productivity market there, as well as inflation frameworks. And this is kind of like my next point as well. The other major thing that I took away was that at the end of the day, he and his committee still believe that the 2% target is intact, which when you look at the current state of inflation in the US, it's over 4%, right? So there's quite a bit to come. There's quite a bit of work to be done to see that come down to that 2% target. So, while there is potentially a task force looking into reimagining, well, is this the right model to use? Does it make sense in the current landscape? It doesn't change the facts that what we are now looking at is a market with an elevated inflation rate. And historically, the way that you get inflation rates down is to basically curb spending or to reduce people's spending. And a way that you can get that mechanism is through interest rates. And when we look at the market's response to all this news, that's essentially what I'm seeing is happening in terms of how the market is responding to this matter. The chart of the week this week basically looks at understanding the bond market. How is it positioning itself? And the bond market's, it's pretty clear in terms of the signals that it can send, particularly with this chart. The black line here represents something called the 2s10s, which is essentially looking at the interest rate paid on a 2-year maturity yield bond versus a 10-year. And very simply, what this means is usually when policymakers make their changes on interest rates, you see that reflected on the front end of the curve. So like something like your 2-year yield interest rate. Whereas the more sticky and more, I guess you could call it the more durable risks in the market, they tend to reflect on the longer end of the bond market, which is, for example, the 10-year. So this gives us almost like this barometer of how is a market thinking about inflation on the long end and growth, as well as interest rates on the short end. And when you put this equation together and you see a chart like this, when it starts to move to the downside, it tells you that a scenario is playing out where the market is expecting less growth and less inflation. The two often go hand in hand. And then secondly, they're expecting higher interest rates, that denominator that we can see, or that secondary element to that equation increasing is drawing down this particular metric. And when we put this aside against a chart like Bitcoin, historically, this has been periods where we've seen that the bear markets in the most recent cycle really start to extend, when we did see that rate hiking cycle in 2022. And that's a key takeaway from me out of this. Of all that was said and that was going to be done, like, yes, there's huge reform coming that will likely impact us beyond the months and weeks ahead. It's, this is a multi-year change. And even in terms of these committees and task force, a lot of their mandates, they won't land until the end of this year and beyond. So the market's immediate reaction so far is hawkish. It's quite bearish. They're basically seeing this as a reason for maybe a risk to be, well, at risk. And to be honest, unless we see something change in the next couple of weeks, maybe this is the new trend that we're going to see. We're going to see the market potentially de-risking. This could be the start of a new downtrend for the markets. But I'd also throw out, that whole idea of like, what are the other scenarios out there? Yes, this is the immediate reaction, but what are other things that we can look to understand what could be coming next? And, I talked about here where the front end of the curve, it's basically owned by policy. The change in the interest rate at the banking level will influence the 2-year interest rates. But that 10-year, that's again governed by growth and inflation. There's nothing that the policymakers can really do about that in the short term. It's the market's perception on it if inflation and growth is going to go to the upside or downside. And a major driver for inflation has been oil, right? We've seen a huge change in the price of things like Brent crude, which again, oil through the Strait of Mars, like that's been an ongoing issue for many, many months. And we will stay away from the politics of it all. But what you need to know is that it's capitulated like 35% in the last couple of weeks. So in the last few weeks. So this is a pretty interesting trend when you think about, well, one of the major inputs, we talk about inflation being a concern. We've seen just one of those major inputs absolutely, fall off a cliff to some degree. As fast as it raced higher and caused the last few prints to potentially move a bit to the upside, we're now seeing the opposite happen and that retrace. So could potentially the Fed's job be done for it in a way, just with oil prices normalizing and coming back into range medians? These are just some moving averages I've got on the screen as well. So just showing like a reversion to mean. And that's the key thing that I'll be watching as we move into the next few weeks ahead. Yes, we're seeing the market expect rate hikes to happen, but what if we see also at the same time, some of these inflation drivers really start to come down as well through energy costs as well. It's a very interesting transmission, I think, to watch in the coming weeks. But, overall for me, this was, definitely a meeting that didn't disappoint. If you're ever interested in this sort of stuff, I recommend you at least check out the press conference, even playing it at 1.2 speed if you don't feel like you've got time for it. Just even hearing Kevin Warsh address the market and the journalists even in the room during the conference time, it was pretty eye-opening, particularly just showing all his cards to some degree. Like, he's not giving away anything that he's not comfortable to, but they're holding that resounding message that the Fed now they're basically they're gunning for change. They're all looking to make things better for the longer run, and they all agree that the current system, it's not fit for the future. So I think that's a really, really important takeaway, especially as we've moved through some pretty volatile years in these last 2 years, in my opinion. But thanks very much, guys, for hanging around this long. I hope you have a lovely rest of your day, and we'll be back again to just keep following the story along. This will be something that we have definitely got more to unpack as the months roll by and the weeks roll by. But definitely be a heavier emphasis on the data that comes out now, as Kevin Warsh has made everyone known after this meeting. Thanks very much. Thanks very much, everyone. Catch you later.